Hey guys, Mike here. So another ball today, yesterday, and some big swings, and that's 2 Fridays in a row. I guess we've had pumps like that after big sell downs, and so we'll see if that's going to start being a trend or not. We'll get in that into tomorrow's video, and we set up the week, which is going to have a lot of economic data. Don't really have to worry about earnings too much. But today you asked really good questions. One, which we'll get on right away. When you look at the charts, what are you looking at as far as like looking for a correction or a crash? And so we'll look at that. Also, I think one of the questions was, what would you buy in the next crash, like for your 401k or something? Or what would you put into that? So we'll look at stuff that actually does well during a crash, if that's the case. Also, remember, you won't know you're in a crash until you're in the crash. Okay, so by then it's a little too late. So you got to kind of speculate. Another one we'll talk about, and I'll show it to you because the video just came out yesterday about this, or the interview. Why would the Trump administration try to drive down the 10-year yield? Why are Chinese stocks pumping, even though we're on inflation, and tariffs and all that stuff? We're going to talk about all that, but you'll get to hear from his administration. And the one thing about this guy, I've never heard of him before, but he is super straightforward. He's telling you exactly what they're doing, so don't believe them, but so forth. That is what's happening, and to let you know they're not really so much worried about the stock market, and you'll get to see what they're talking about. And then there's a couple other questions we'll get into as well. So appreciate all the questions. Feel free to put more in there for next week, and feel free to answer some of these as well. One at the end I'm definitely going to ask you guys about and get your opinion on. First one here says, hey Mike, question for today's video. Can you explain what to look for in the charts when it comes to difference in a correction and a crash? Just remember, a correction is at least 10%, right? So the Qs have already hit that, the SPY has not. And so one thing, when you're in a correction, for example, you're really looking for a relief rally at some point in time, and you're trying to hold the 200. If you get below it, you're looking for a rejection when you head back up to it. Now, as far as crash, here's the thing. What you want to look for to know, like, hey, this is going to signify at the beginning here, what's going to happen is a death cross. It's when the 50, that yellow line, a green line, color line, whatever it is, crosses that red one, which is the 200. So the 50 crosses down through the 200, called a death cross. I love that name. This is like 2022 right here. Boom. So it gave you plenty of signal, right? Now, is it 100% accurate? No. Right? I mean, that's 2020, and right there what happened, because this is a 30-day crash. If it's a very short one, especially like a flash crash, you're gonna, if you try to sell right there, it's already coming back up, right? 2018 actually would have been pretty good right there. It would have saved you quite a bit. Okay, I kept testing 200, death cross, down we go. You don't get a lot of these. It's not a lot, not until it's going sideways like this. When it goes sideways, then, now, of course, if you'd have got out, probably saved yourself a little headache there. That's when you'll have them. Right now, you can see our 50 is way away from the 200, mimicking more of what happened in like 2022, 2008, 2001, right? That's what it's mimicking now. And we'll just keep scrolling back. You can see, I mean, you can count on your hand how many times this has actually happened and stuff. There's another one. And these aren't crashes, by the way. These are literally corrections, okay? Because that says 20%, but I don't remember 2011 having a crash. Do you? I mean, I don't really remember that. But anyway, and this one right here, the same thing. I mean, that's not a crash. But here's 2008. And so you can see right there. And another thing you're looking for too is not just this. It's if you get below the 200, usually you'll get a retest. Not 100% of the time, but usually you'll get a retest of the 200 from the bottom, and you're looking to see if it rejects it. Okay, that's going to be the big thing. Another thing, so death cross, rejection at the 200 when you try to come back above it. Okay, because you're going to get these counter rallies, bear market rallies, relief rallies, whatever you want to call them. You can call them many different things. Okay, so that is something you're looking for, and our 50 is nowhere near the 200 right now. So just kind of keep that in mind. That's another thing. And right now you still have an inclining 200 at this point in time. Now, something else to look for, you need to go to the higher time frames to look for this. But I actually have a calendar in mind on this to look at this every single month. But it's going to the monthly time frame and pulling up the RSI and your MACD indicator. These are your momentums. Monthly is a big, big time frame. So when this shifts, it's like a freighter in the water shifting. It's not hard. It's not, easy to turn like a cruise ship, is it? No, it's not. Easy to turn a speedboat. That's like your, hourly, 2-hour, 4-hour freight. The tugboats more the daily. You go to a monthly, 2 weeks, stuff like that. You're talking about a freighter, a cruise ship's very hard. This RSI is already across this moving average. That's the indicator to say, hey, wake up. But we have not had a MACD cross yet. Okay, and when we do, that's usually signaling, oh yeah, it's going to start going down more. It's not going to go straight down, but we're probably heading down more. Like you saw in 2022 right there, you can see it many different times. And we have not had many bearish MACD crosses. The reason I say the RSI crossing the moving average is just a warning sign because you've had many more of those, okay, versus the actual MACD cross on the monthly chart. So pay close attention to that. It looks like it wants to do it, right? I mean, it's turning over. So is it going to happen there? Are we going to get some red on the bottom of that histogram right there? That's going to be key. Is any of this 100%? Nothing's 100%. It's the stock market, okay? But I implore you to pull this up in your chart and go through and study it. That is your job, okay, to go through and study it. Right now, we know dang well the SPX is, or the SPY is above the 200 moving average. That's where we closed at yesterday. It was below it. And so that is key. Another thing to make sure you keep track of, which is what I do for the members and stuff, when we do videos and stuff, is your bond market. Everything's based on the bond market, not the stock market. The stock market reacts off the bond market. So HYG, for example, is your junk bond market. Okay, that'd be the first to go in a major crash if we're getting there. And then, of course, you'll have your volatility in the bond market, which we're still having right now, and your spreads will blow out. Okay, so just make sure you're looking at that right there. That's kind of a red flag when you're looking for stuff like that. But keep in mind right now, currently, we still hadn't had a relief rally, which is kind of interesting, right? If you go back and look at the other times that we started selling down, usually you'll get some kind of bounce. But remember, the daily on the SPY isn't even oversold yet. I think it's getting close to reaching it. And the last few times it's done now, on the daily, we've got at least a relief rally, oversold bounce, whatever you want to call it. People got different terms for that kind of stuff, you know, and you won't know if it's the real deal. And we're going to all-time highs again, you know, unless it starts building out structure, right? Breaking certain levels. But I showed you yesterday the 3 things to watch out for to show what has to happen to actually have a significant rally right now. Okay, so go back and watch that video if you didn't see that. So hopefully that helps out and stuff. But first, let's get to the 10%. That'll be a correction territory, okay? And see what happens there if we get there. And the next one here says, why would the current administration be trying to push down the 10-year now? And this is something to remember going forward here, guys. Remember, the Fed's fund rate you hear so much about, and they want them to cut it and stuff, that influences the savings rate. I don't know if you got the emails I've gotten, but they've done, like, was it 3 cuts now, I believe? And so when they've been cutting, that brings down, you probably got the email saying your money market doesn't pay this anymore. We brought it down, okay? Because that's what that influences. The 10-year influences borrowing cost. Might have noticed, as the 10-year has been coming back down, what's been going on with the 30-year mortgage? It's been coming down now, okay? That's why you see refinancing going up right now. And so it influences the borrowing rates. So that makes sense. So that's why they're trying to get this down, because remember all the companies took all those trillions of dollars of money out in 2020 for free? The government, by the way, is the same way. I think the government's got like $5 trillion they got to redo or something. But anyway, there's companies, we're talking about trillions of dollars had to be refinanced this year. And so at these rates, that is not good. Okay, so that's why they're trying to do this. All right, so higher rates it's supposed to slow down the system. The reason why the system has not slowed down like it did in other cycles, which are normal cycles, is because we printed, what was it, $8-9 trillion and sent it out there, so and flooded the market with it. So that they're still trying to get that liquidity out, okay? Because we would have been in tightening conditions by now a long time ago, but that's what's kind of throwing this one off. So hopefully that makes sense. Just remember those 2 things, though, when it comes to Fed funds rate, the 10-year, what they affect. Now, next one says, please explain in more detail why Chinese stocks are rising this week with the tariffs announcements. Shouldn't they go down due to the risk and cost? Now this, what I'm about to read you, goes back to that question I just read. And also the answer is no, because it isn't the tariffs that have anything to do with China. Remember, Biden never took the tariffs off of China, ever. Okay, and so the reason why is this right here, that Chinese stocks are going up. And also another reason why the Trump administration is trying to run down the 10 years. Let me just read this real quick. This is what the Trump administration is attempting. As far as I know, it has never been attempted. I have been saying for 3 years and showing the charts depicting how the market is an addict for government liquidity, which is spending. Now they are trying to change that. But anyone who has any experience with drug addicts, and I have a lot in my family, knows they don't get clean easily. It is constant battle with many ups and downs. This is exactly what you are seeing in the market now. The addicts fled to areas of the world that are feeding their habit, like China. Areas of the world that are performing economic stimulus measures, free liquidity. Now we just have to see how serious the administration is about this course of action. Only time will tell. And here is one of his administrators talking about this, and he's telling you exactly what they're trying to do.
But the Biden administration created this bad equilibrium where the top 10% people in this room, probably most of the people watching this show, top 10% of Americans are 40 or 50% of consumption. And that is an unstable equilibrium. The bottom 50% of working Americans have gotten killed. We are trying to address that. We're trying to get rates down. And could we be seeing that this economy that we inherited starting to roll a bit? Sure. And look, there's going to be a natural adjustment as we move away from public spending to private spending. The market and the economy have just become hooked. We've become addicted to this government spending, and there's going to be a detox period. There's going to be a detox period.
I think that temporary pain that you've acknowledged, that the president has acknowledged, I think the question becomes, is temporary pain the new transitory inflation? How do you know that we get to the other side of this, and how long do you think it actually takes?
Well, look, there's an adjustment. We'll see whether there's pain. What we are trying to do, I talked about it at the Economic Club of New York yesterday, we are trying to transition from public to private. And I talked about we are going to have safe and sound regulation to get our banking system going again. So the banks should be generating loans to private companies. Employment should be from private companies, not from government.
And so can you be more clear, folks? Like, I don't know what else they can say to make people understand, like, there's going to be pain. I mean, that was actually, I think, pretty sure Donald Trump's exact words. Hopefully it's just short term. I don't know what short term is to them, right? But right now the market is trying to figure out, like, wait a minute, are they going to go through with this? I don't know. I mean, people, politicians say they're going to do it. And if they go through with this, there is going to be pain. There's no way around it. You cannot take a bunch of liquidity out of the market and go, oh, yeah, the private sector is going to be the one to take care of that. Like, come on now. I mean, we know better now. What's the private sector doing right now? They're laying off people. There's no big mass hiring going on in this country. There's a reason why they gave those government workers 9-month severance. There's a reason why they're offering $50,000 for government workers to retire early. Like, there's a reason for that. Okay, they know. I'm pretty people have told them, like, you're late in the business cycle. This ain't like some beginning of a new business cycle here, right? You're late in the business cycle. And so, the question is, are Americans going to be able to handle what the pain is? The one good thing I'll say this, I was telling members, I'm happy I ain't retiring this year, because I would not want to be looking at my investments this year sitting there going, man, if I'm retiring, like say December or something, November, whatever, and going, where is this going to be? Right? Because when you retire, you're done working. There's no more paychecks coming in. And it's like, where are my investments going to be? Because I remember those interviews for those people after the dot-com bubble. They were supposed to retire right when the dot-com bubble happened, right when '08 happened, all that stuff, right when 2020 happened, and we shut down the world. Can you imagine? Like, and it's just a lot of uncertainty for them. Like, oh my God, I need this money, and where's it going to be? You don't know. So if this is a great reset, the market's got to figure out what that means, and they're going to follow through this. It's going to be a real thing. Who's going to pick up that dime? Because they're not just going to take a whole bunch of liquidity out of the market and go, all right, we're fine with it. No, that's why they're picking up their ball and they're going to another playground, China and Europe and whatever else. And why that happens here. Okay, that's why you see every red day in America, Chinese stocks, European stocks going through the roof, right? That's not an accident, folks. That's not an accident, okay? So let me know what you think about that. Hopefully that makes it clear right now, okay? Now, looking at this one, hey, Mike, you haven't mentioned the Fear and Greed Index in a while. We've sitting in extreme fear for a week or so now. Any thoughts? Well, I'm very proud that I haven't actually mentioned the Fear and Greed Index on purpose, because I have showed you guys what. I track this every day for members. I know what it is, and I've told you guys it's broken. The reason why it's in extreme fear right now already is because, and this is the problem, I know it's all over Twitter and all of these people, the people that don't ever track it, and all of a sudden when it gets in extreme fear, they want to fear monger you and go, look, it's in extreme fear. Can you believe this? I don't understand. Why is it in extreme fear when, we're only 7% off all-time highs? Because it was broken at all-time highs, silly. That's why we were sitting in neutral at all-time highs. Then we set another new all-time high. We're normally in greed at that point in time, or at least approaching even extreme greed when you start reaching these all-time highs multiple times in a row. But it was in neutral. It was like at 46 or something. I don't want to get the exact numbers. I went back and looked. And so, of course, if you're starting in neutral and not up in greed or extreme greed, it's going to be in extreme fear very quickly. Okay, that is why. So for those wondering, that's why I haven't mentioned it. I want to be the only one putting out those videos, because one thing in my videos, I don't fear monger you. I don't put crash in the videos. If I do, you better dang well pay attention, because I rarely use the word in the videos or in the especially the thumbnails. Okay, That's why it's broken. It's broken because the put-call ratio is messed up. And you can pull up. I showed you guys in videos. You can pull it up and scroll down. It will show you. And there's certain categories that have been in fear and extreme fear for like 6 months. Most of them have to do with the bond market put-call ratio, breadth, that kind of stuff. And so that's why. That's what's going on, folks. But you get these geniuses out there, they're trying to scare you up with the clicks and go, extreme fear. Why is it in extreme fear? We're only 7% down. That don't make it. In 2022, we're at the same level. It started in two different places. We were in extreme greed when 2022 crash started. That's where you usually are before the crash. Not this case. Okay, so hopefully that helps out. Not to be aggressive on that. But next one here says, where would you put your money during the next crash if you had to stay in the market, i.e. 401k? Well, one, like I said, you will never know you're in a crash until you're in the crash. Okay, remember, a crash is 20% or greater right there. But let's just look real quick here, guys. One is going to be bonds if there's actually not just a crash. Here's the deal. Recession, okay? Because this right here is a recession. The shaded area is a recession. That's 2008. It goes up the most because I'll show you in a minute why. But look at this. This is a 2022 crash. Well, TLT dropped, which that, of course, tracks a 20-year bond. And so if you pull up the 10-year, the reason why it's important for there to be a recession during the crash, because that's when yields plummet. And when yields plummet, TLT pumps, okay? Yields rose in 2022, which was very rare to see, to be honest with you. And so it is important, and more important really, that there be a freaking recession if you're loading up on bonds and TLT, because if you go through and even look at 2018, TLT actually dropped with the market, right? Because there was no recession. And so you had to be a recession for TLT to really thrive, okay? But you can get dividends and all that fun stuff. So that's one place if you're thinking there's going to be a recession and the 10-year, the 10-year is going to drop, okay? Other places, you can look up here and say, okay, so some people say, well, hey, Walmart. Everybody's got to go to Walmart. There are some stocks that will still drop, but they will do much better than others, okay? And so that's one thing to kind of look at. That's 2008. You can see right here, .com. And you keep scrolling across. So you can pull Walmart and play around with it. But again, it's still a stock. It's still a company. And a lot less people will be shopping. I mean, even they got to have Walmart. XLV's healthcare. That's defensive, right? Everybody's got to have healthcare. That's 2008, dropped. 2021, dropped. So it just doesn't drop as much. So it's like a safe haven and people collect dividends. And you look at that right there. But let me tell you something. Again, one more real quick before I forget about it. XLP, again, that's actually two more. Consumer discretionary, you can see it didn't go down as much, but still dropped. Okay, just keep that in mind. Another one is going to be something like a Guggenheimer, like people want to do like a dividend thing, right? So Guggenheimer Strategic right here, it pays a high dividend, but still the stock itself is going to drop. Okay, that's just the way it's going to be. But you'll get a nice dividend and stuff. And don't ever let anybody tell you that cash is not a position. I remember 2022, all those geniuses out there trying to make you feel bad. Oh, cash is trash. You remember that? Cash is trash. Cash is trash. And all of a sudden we got down to about, I think it's probably 15% in the S&P, and it started looking really bad. And all of a sudden those same folks were like, maybe cash ain't trash no more. Because, for those geniuses out there that want to sit there and make you feel bad about keeping cash in a portfolio waiting to buy, well, let's see here. If the stock's $100 and you have $10,000, how many shares can you buy? Then the stock drops to 50. You still have $10,000. Can you buy more or less shares? You can buy more. So cash does gain value. Remember, the savings rate is going to go to zero in recession. So you ain't going to be making no money off that cash sitting there, that's for sure. But you're going to be gaining value. You just don't know about yet if that stock keeps dropping that you want to buy, and your cash stays here and the stock goes like this, you can buy more shares, right? So technically you did gain something in that. So cash is king, and especially in a crash. That's just the way it is. So let me know what you think about that. Let me know what you would buy and everything. 401ks are limited, so I'm going to open that question up to pretty much any kind of account, okay? Now, next one here says, are we finally seeing the real unlocked numbers GDP-wise? And this one right here, I'll tell you, man. And what this person is talking about is that Atlanta Fed GDP numbers that came out that dropped us from positive to negative 1.8 to negative 2.6, I believe it was, then went back to 2.4 the very next day. That number is based off a bunch of reports that come in, and it just keeps changing all the time. Do not forget, and you got to go back and look at what caused that huge drop. But understand, 2022, they had us negative, what was it, like negative 3% or something, like 2 quarters in a row, negative GDP 2 quarters in a row for sure in 2022. And I've been saying we had rolling recession, but there was no recession. People were out partying, cruising, blah, 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 in Vegas. Like, that was not even a recession I've ever seen before. And it has some huge drops. At one point in time in 2022, we were at 6% GDP, and it drops all the way to like 2. That's a 4% drop like that. And so, it's going to change. It's going to keep changing. And that's why these are just anything else, like calculations, right? And that's why I tell you, they've never predicted, as far as I know, they never predicted it beforehand. Like, they keep trying, but that number is going to continue to change, okay? And so, are we getting the real numbers? I just know we're getting numbers, because numbers were all messed up in 2022 and 2023. But here we are, and so we'll see. Now, this is where I want you guys to answer this, because I'm not a dividend person, but what are your top 3 dividend ETFs for long term? And then this person comes out and then puts in here their 3: QQQI, GOF, which I just showed you, SPYI. There's another one, but I can't think of the ticker. So please put in the bottom what your 3 favorites are, and kind of put why. I mean, what's the deal with what do they pay, and what do you love about them and stuff. So I know for sure in the next crash, I'm going to force myself to start being a dividend person and allocate like 20% at least of the portfolio to a couple different dividends stocks when they crash. And once we crash and I feel like we're bottom, I'll buy them then, because at least I'll get something on the pull back up. And then just keep that dividend rolling in and but add cheap and get a lot more shares, so I can get a lot more for my bang for my buck. But yeah, I'll definitely do that. But put your bottom 3 in. Obviously, put what you would let, stay as far as in your 401k and accounts to ride down a crash. Put those in as well. Feel free to put more questions for next Saturday's video as well and answer some of these. Appreciate you watching as always. Hope you have a great rest of your weekend, and I will see you tomorrow. Don't forget, hit that like and subscribe button. Think about signing up for that membership. Unless that McDonald's combo, I ain't put no inflation on you, have I? Anyway, have a good one, guys.